Welcome to Short View Trading. It's Monday, 12th of December. It's early, around 9 a.m. London time. What matters for markets on a 1 to 2 week view? If you're a swing trader of equity index futures and you're looking to take positions long or short on the index for a 1 or 2 week basis, what do you need to think about? What really matters? What factors are going to drive that trade? That's what we're going to dig into in this video. Well, it was a tough week for equities last week. Key US equity indices all sold off over the course of the week. The S&P 500 was down 3.3% of the week. The poorer performers were in fact the mid caps, the Russell 2000 and the small caps, as well as the Dow Jones Transportation Index, as you can see in this chart in front of you now. But having seen that weakness in the S&P 500, the index is now poised at a key level. In fact, we've had a trading range in place since post the CPI number back in November. On the 10th of November, you'll remember markets rallied very hard on the release of the CPI data print. After that, they basically tracked sideways in a wide consolidation range since that time, since the 11th of November. That range, as you can see on the chart in front of you now, is 39.12 at the lower end, up to around 4,090 and change at the top end of the range, a level it reached at the beginning of December. And on top of that consolidation range, what you've also seen is we've been back at the top end of the uptrend channel. The chart we're showing you now shows you an S&P 500 candlestick chart, and you can see that uptrend that's been in place since the early October lows as this rally's been playing out over the last couple of months. A few days ago, earlier this month, we're at the top end of that range. We've also been testing the 200-day moving average on the S&P 500, and we've eased off of those levels over the course of the last week or so. So where does that leave us? Well, this is a huge week for markets in terms of macro and central bank action, but also in terms of seasonality. And also it's really interesting to see what our short-term 1 to 2 week market timing models are up to. But in terms of the first factor, the macro, the central banks, of course, we've got CPI on Tuesday. And as I just said, last month when we had CPI out, the S&P 500 rallied 5.5% on the day. How's it going to perform as we get into tomorrow is a massive open question. And in terms of our world, it's very difficult. It's an exogenous event. To predict that and make money out of it is very challenging, particularly if you haven't got a clear message from the models. So all eyes on Tuesday, critical. All eyes also on Wednesday. We've got the Fed out. We've got the Fed dot plots. We've got the economic projections. We've got the monetary policy decision, and of course, we've got the Jerome Powell press conference, 7:30 p.m. London time. And then there's more on Thursday. There's the ECB and the Bank of England as well. So it's a huge week for macro, huge week for central banks. It's also a big week because of seasonality. People often talk about the Santa rally. They start talking about it in November, but in reality, it really only starts in the middle of December. When you get to the 11th trading session in the month, which comes on Wednesday, the day of the Fed, interestingly. When you get to the 11th trading day of the month, you normally start to drift higher into the end of the year, into the 31st of December. And that's what you can see in this chart. This is the seasonality chart we're putting up in front of you now. This looks at the average seasonality over several years and shows you the median, the quartiles, and the average and where we are at the moment. As you can see, the weakest point of the month is generally the 11th trading day. And then, as always, on top of that, we want to add into that, how do the models look? What are the short-term models saying? What are the medium-term models saying? At the moment, the short-term models have been moving lower, particularly with that weakness that we saw in markets last week. And we have some of the technical short-term models, these 1 to 2 week market timing models, starting to get back onto buy, as you can see with the short-term technical scoring system. That is not yet an across-the-board message, and medium-term models are not giving that message at all. So there's three key factors to focus on at the moment. The macro and central banks, number one. Number two, the seasonality. And number three, the positioning of the models, both short and medium term. So where does this leave us? How should you play this market? Is it going to break to the upside on CPI and the Fed? Are we going to break to the downside on those data points? Is the Santa rally about to begin? Or are we just going to trade back to the top end of that range? Well, that's exactly what we're going to be focused on each and every day in the Daily Rag, the Rag Trader, as we publish it every morning around 8:30, 9 a.m. London time ahead of the US Open. And if you're interested in a free trial of that, simply click on the link below. We'll send you the Daily Rag for free. Put in your name and email address, no credit card details required, and we'll send it to you for free for a bunch of trading sessions. Or if you're a subscriber, please click on the website to access the latest. But what we know for sure is it's going to be a fascinating week. So that's it from us. That's your morning market hit. Thank you for listening. Please do subscribe on YouTube. Simply click on the subscribe button and like and share if you like this video, or follow us on LinkedIn, Twitter, and or Facebook. Thank you for listening. Stay safe. Trade well.